So thanks for joining us again, Mark. I think it's been a busy few weeks for you guys in the mortgage world. A lot's happened since we last spoke. Interest rates, prime ministers, chancellors, you name it, it's happened. So what we said we'd do today was give people just maybe a really quick overview. I know we could spend hours on this call talking about the mortgage market, but maybe some hints and tips and some takeaways. And then if anybody wants more information, obviously they're more than welcome to get in touch with us or you guys direct from there.
Yeah, lovely.
Okay. Good. All right, so what's happening in the mortgage market? What's happening with rates? I suppose, shall we start with what's happening with rates?
Yeah, so I think the key thing with rates, as we all know, with the Bank of England putting up interest rates to an all-time high for a very long time at 2.25, lenders are reacting quite cautiously, shall we say, and they're pricing fixed rates at an all-time high as well, or certainly not an all-time high, but certainly a long-time high. Historically, where we might have been speaking to first-time buyers and home movers and people getting buy-to-lets, anyone purchasing property really has now found if they're financing through a mortgage, 6 months ago, you're probably going to be looking at your payments being maybe £250 a month more to £300 a month more plus, based on the interest rates now and since back then. So it's a big impact on a lot of people who are looking to finance property. I think the main issue really is not necessarily, I think people expect interest rates to go up. You know, they were at an all-time low when the interest rates were 0.1%, but the speed they're going at, you may have a client that say look for a property around in July time. I'm sure you've had them as well, and we've had scenarios where we've helped to be your clients that were quoted say 2.5% that are now actually found a house, all happy to go, but they're looking at sort of 6% on some occasions. So it's an unusual time, definitely.
Okay. A question I've been asked a lot recently is why is there such a difference between what the base rate is and what the lenders are offering? Because usually it tracks it quite closely. So if the rate was 1%, you might have got a 1.5%, 2% deal. Why is there such a jump for 4% in some cases?
Yeah. Well, without getting to the economics of it all and everything like that, I'd certainly never call myself an economist, but to keep it simple, lenders base their lending decision and their pricing on fixed rates based on what's going on in the markets. You may have heard the term swap rates, which is there's a lot of factors that make up those rates, so that they'll price based on that. Whereas a tracker rate, I think you'll probably be aware, you've got the Bank of England base rate and you've got a rate, say a tracker rate that will track what the Bank of England base rate is doing. So you might have a 1% above Bank of England base rate, which means you'd have a 3.25%. So because you've got that level of the possibility that interest rates will go up or down over time, lenders are generally more comfortable to have something that tracks a base rate and perhaps price a bit more competitively because they factor in a bit of that risk that rates might go up or down. Whereas fixed rate pricing is generally based on what lenders as a whole and the market feels like what's going to happen to rates over the future. That's pretty much it, as simply as I can put it.
You mentioned tracker there, and that's not been a term we've heard mentioned much over the last 10 plus years. Do you want to quickly explain why they've become more popular?
Yeah. So 12 months ago, when base rate was very, very low, the 0.1 or even 0.25 in the noughts, you'll find that the general feeling was there wasn't much rope for the rates to actually reduce, so they're only likely to go one way. So we've got brokers that work for us that may have joined us, and they haven't even discussed tracker rates with any client, because who wants to track something that's very likely to go up? Now we're in a different world where actually the difference between pricing between a tracker and a fixed rate at a similar loan to value might be the difference between 3.5% to 6%, which could make a massive difference on somebody's mortgage payments. You're probably talking about £300 a month, depending on the mortgage size and deposit amount. So it's not really been something that's been discussed in the past. And certainly if you're a first-time buyer, you would need to have that normally first-time buyers want that peace of mind built in. But now we're in a scenario where there is potential for the interest rates to go up or down and change. And it's our job as a broker, or if you go to any other broker, they should be having a discussion with you about what your appetite for risk is, and the fact that if the interest rates do go up or down.
Yeah. Okay, good. Definitely an option for people these days, which again, over the last 10, 12 years, has not really been needed. The other thing I'd like to clear up here, I suppose, is there's almost three categories. So we've got people that have got mortgage offers, they've agreed to purchase, that's going through. And there's a little bit of fear around that could be pulled, the mortgage offer. There's people that have locked in the rate applied, going to or had survey, but yet haven't got a mortgage offer. And then there's people turning up with agreement in principles or mortgage promises or whatever you want to call them, but from 3-4 months ago. And we all know, I don't think any lender's going to be carrying on those agreements with the mortgage promise. So could you talk us through almost those three scenarios and what a customer or a consumer could expect to happen?
Yeah. So I know we've spoken about this before, but you've got a lot of scenarios in the media at the moment about people saying that they've had mortgage offers pulled and things like that. So there's three fundamental parts of the whole process. So what would normally happen is we'll have a client that will come to us and say, look, Mark, I'm really interested in buying a home in the next, say, 3 months or so. I need an agreement in principle. So that's normally the stage one. So they'll come to us, and at the time we will give them a quote, and the interest rate, say 3 or 4 months ago, may have been 2.5-3% at that stage, but they may well have taken 3 months to actually find a property. So at that stage, when they're ready to apply, the interest rates have actually gone up. And what they found is that the deals that are available at the time when it comes to submit the application are much higher than when they first started shopping. So there's lots in the news about offers being pulled and things like that. There isn't generally offers being pulled as in there's a formal offer. So you do the agreement in principle, that doesn't lock anything in generally. When you apply for the mortgage, your rate is generally locked in. Pretty much with most lenders, I'd say 99.9% of lenders, your deal is locked in. So if you've applied for whatever rate at that time, you've done the application, you've locked it in, then the valuation happens and all those sorts of things. When you get your formal mortgage offer, when everything comes back, that is a formal mortgage offer. Okay. So I think what's happening in the media is lenders are pulling rates, but then the media is saying that, oh, people are losing their mortgage offer. But that agreement in principle quote that you had at the very start of the process isn't an offer that's being pulled. Once it's formally offered, you generally have 3, if not pretty much 6 months to complete on your purchase once the offer's actually been issued. And that's the key milestone, really. So the sort of timer, if you like, starts at 6 months.
So
when you get the offer.
Forms obviously aren't locked in and they could change day to day, which I think they probably are at the moment. If you've applied for lock that in, irrelevant of whether a survey's happened or not, that should be secure. And if you've got a mortgage offer, you're good.
Yeah. So once you've got the mortgage offer, it's legally binding. And if it's to buy your house and everything like that, then from there, you'll. Sorry, someone just tried to get in. So, once you get your mortgage offer, you've basically got 6 months on average. Some are 3 to 6 months to actually complete on the purchase. Nothing should change. So as far as I'm aware, very few, if any, mortgage offers have actually been pulled at that stage.
Can I ask quickly, Mark? I mean, we've literally had a customer in today buying a property. Their offer expires in a week. They've had some delays in the purchase. Not their fault. It's actually on the seller's side, which are unavoidable. They're really nervous, obviously, about will the lender actually extend the offer, which used to be a norm. Really, you wouldn't worry about that. What's your experience with that over the last few weeks? Are they extending for shorter periods? Are they just not extending at all?
Yeah. It's very different lender to lender. So a lender that normally goes to offer and gives you a 3-month offer will normally have in the bank, if you like, an extra 3 months should there be any delays. I mean, I know that you guys are obviously very helpful in the new build market. There's normally a lot more flexibility with new builds because there's not only delays with the buyer, obviously there's the building delays with materials and all that sort of stuff as well that might come up. But generally speaking, if you've got a mortgage offer for 3 months, there's a bit of scope sometimes, depending on the lender, to put another 3 months on, or some lenders may just be 10 days. And often it depends on how close you are to completion as well. So if you're literally right on the deadline of your offer expiring, but you just need to get some final bits and pieces done on the legal side, lenders are generally quite flexible with perhaps giving you 5 or 10 days, as long as they know that there's a completion in sight. But if you've lost a property, unfortunately, and you're coming to say 2 weeks before your offer is expiring, a fair few lenders, not all, would actually extend the offer. We've got one exactly at the moment. I had a client that was buying a buy-to-let, and their offer actually has got 3 more weeks left, and they've desperately found another property to try and complete and get all the conveyancing done in 3 weeks. We're working with them to get an extension from the lender, and certain lenders are actually open to it. But at the same time, I would suggest anyone in that position brace themselves and maybe speak to a mortgage advisor to get a plan B.
Yeah, okay, good shout. Lastly, I suppose, before we go on too long, again, we've been heavily involved in the investment market over the last few years, buy-to-let investors, etc. We were talking earlier, and obviously the stress tests that the lenders have put in those applications under is a lot higher now. Do you want to quickly give some level, because I know we could talk for probably another hour on that topic.
Yeah.
Breakout session on that, but just give us an overview of what's happening in the buy-to-let world.
Yeah. So buy-to-lets are generally assessed fairly differently to somebody buying a home to live in. You normally have to have a minimum income and all those sorts of things, but not always. But most of the assessment for a buy-to-let purchase, for a mortgage and a buy-to-let mortgage, is actually done by the rental income and the interest of the mortgage, how much that's being covered by the rental income. There's a calculation that changes lender to lender, but in summary, the rate is sensitized. So the lender might say if the interest rate was 5.5%, we would want the rent to cover it by a certain amount. Okay. And then there's the amount that it needs to be covered by, and that can be affected it's generally 145% mortgage coverage you need. Okay. But it does vary lender to lender. Now, the key thing here is, because the rates are so much higher, lenders are sensitizing rates a lot more aggressively. So instead of them working it out as if the interest rate was, say, 5.5%, some of them are 8 or 9% now because of where the interest rates are potentially going or have gone. So what that means to investors is they need more rental income to cover the same amount of mortgage. And a big trap at the moment is you may have a landlord that's actually coming to the end of their mortgage deal on a particular deal, and they want to remortgage, or also more likely take some more money out of the house. But the goalposts have now moved for landlords, where they perhaps may not be able to get as much mortgage based on the rental income that they receive, due to the way that lenders actually stress test the rental income. There are ways around that. I definitely suggest we have another conversation about it, but there are certain lenders that can take some of the client's personal income in, or maybe the income for the background property portfolio if they've got one. And there are also lenders that, well, the rules are slightly different for a limited company. So perhaps a lot more investors may look at limited company purchases a little bit differently and a bit more favourably as well. But obviously you need to speak to your accountant about if that's the right way forward.
Yeah, okay. A lot of detail to uncover. Well, thanks for today, Mark. That's been really useful. I think in a mortgage market that's almost changing daily, it's really useful content for some of our listeners. As always, if you guys have got any questions or queries for Mark, or want to speak to him, have a current sale or purchase going through, and you're worried about the mortgage, then please get in touch and we'll happily introduce you to Mark and his team. But yeah, cheers, Mark, and have a great day.
Sandy, good to speak to you.
Thanks, mate.